Okay, welcome back, everybody. This is Pitchfest Semifinals, round 4. Been here all day, and we actually have a lot more to go. So you know what happens here. There's going to be 8 companies chosen from across the world. 7 countries flew themselves here to represent themselves on this stage. One will win this heat and will be pitching in the finals tomorrow on the main stage. As always, we have 3 judges, and as always, they are new judges, and they're best in class, and they've traveled to Toronto from far away. I just want to introduce them, and they can come out right now. Sunny Parekh, who's a partner with Reflexive in New York City. Leah Cowan-Butler, she's a director with Emphasis, and she's based in Manila in the Philippines. And Daniel Casares, he is with the Stellar Enterprise Fund, and is also based in New York. So I want to welcome the 3 of you to Toronto. I'm very honored that you decided to come here and cross the border. This is great. And I just want to maybe ask you to take 1 minute and introduce yourselves and what kind of investments you're up to. So maybe start with you, Sunny.
Thanks, Anil. My name is Sunny Parekh. At Reflexive Ventures, we're focused on investing in applications and use cases of blockchain and crypto. So how do we solve real problems where blockchain is just a better coordinator of trust, incentive alignment? What we call is eliminating the trust tax we all pay across a whole host of sectors. So everything that's application focused is where our sweet spot is. I come from a background of working in traditional finance. I was at Point72 before doing fintech and digital asset investing. And historically working with a lot of the fintech banks and asset managers.
Okay, thank you, Sunny. Leah.
Hi, everybody. Ooh,
Yeah,
hello.
Okay, good.
There we go.
Yeah.
My name's Leah Cowan-Butler. I write an opinion column for Coindesk, have done since 2020, which is about Web3 adoption in emerging markets, focused on Southeast Asia. I sit on the board of the Blockchain Game Alliance, and my company, Emphasis, invests in very early stage, pre-seed or seed Web3 native ventures with a focus on gaming. We are very interested, as I said, in Web3 native projects. We don't really look at things like Web 2.5. We want to see where blockchain is being used in really novel ways to advance decentralization for the good of the world.
Okay, thank you, Leah. And Daniel Casares, please.
Hey, everyone. Sorry, can you hear me?
Yeah, just really loud. The mic.
Did you hear me here? Yeah, there you go. Nice to meet you guys. I'm Daniel Casares. I'm head of investments at the Stellar Development Foundation. That's us over there. I run the Stellar Enterprise Fund. It is a layer 1 blockchain fund, mostly for ecosystem adoption, based in New York and in San Francisco.
Okay, let's get on with it. So 8 startups, 3 minutes of a pitch, and 3 minutes of Q&A from the esteemed judges. So from New York, I want to introduce the CEO of VTrader. VTrader introduces a new crypto exchange model where users trade for free by maintaining a minimum deposit in proof-of-stake assets. So please welcome the CEO of VTrader, Stephen Gregory.
Hey everyone, my company is VTrader, and like you said, it's a new revenue model for crypto exchange. Sorry about that. It's a new revenue model for crypto exchange where users trade for free so long as they maintain a deposit of proof-of-stake assets. Those assets are staked by VTrader to offset trading fees, so it's super simple, very transparent, deposit, trade free. The reason I did this, I worked at several other exchanges, and what I saw was a bunch of problems with the current model. So essentially, it's very inconsistent. So in bull markets, a lot of people trade. In bear markets, nobody trades. So the revenue is sort of boom and bust. The second thing is that all the revenue is generated from a very small portion of the user base. So I'm sure most of you have looked at like Coinbase's financials and seen that they only make money off monthly transacting users, which is roughly 8% of the total user base. Very, very small. I also think that revenue is assessed in transaction fees, therefore it's always a taxable event, and you have to assess it in notional dollars. There's another problem called the double cost per acquisition, where incumbents have to first acquire the users, which costs money, and then they have to incentivize those users to trade. So it's basically a double spend to get any revenue out of the users. And what we've seen is sort of the old model of the fee to volume ratio has been condensing over time, even in bull markets. So sort of as industries get older, the fees sort of condense. So this sort of is a way around that. My solution, essentially, exchange earns revenue via staking yield without the need for customer action. So the customers will deposit, and then so long as they hold that deposit, they can trade for free. But over time, this is a very strong compounding effect. So for example, if you took 1 Ether and deposited that, you became eligible for free trading. That 1 Ether earns roughly 0.00216 ETH per day. That's property of the company. But then 1 month, 3 months, 6 months, 12 months, 18 months, it starts to add up. We also take a small trading spread. But then if we take the staking yields and reinvest it into our own validators, that creates a self-perpetuating revenue stream for the company. We've built this very detailed financial model, and essentially, I'm happy to share with anybody, but roughly over the same 18-month lifetime value that incumbents report, we'll do roughly double the average revenue per user. And there's a bunch of operational advantages here. So, here's just a little bit of chart that illustrates, how sort of it stacks up, and we modeled this with no price appreciation. So just to talk about the compounding effects of this a little bit. So with just 330 customers, if they're staking Ether, we would be roughly, just in our own ETH validators, be making 32 ETH a month. So that'd be a new validator that we'd reinvest for the company. So that would be revenue forever. By month 18, we have 10 new validators. By month 36, we're deploying 86 new validators. So it compounds very, very, very quickly. So as you can see, like in our model, in roughly 17 months, we're earning over $1 million a month just off this with only 10,000 customers.
That's the time, Stephen, but great job. But we'll just continue it with Q&A. So please, go ahead.
I have a question for you on your double spend. First you said it's to acquire, and then you said it's to kind of incentivize them to trade, right? But doesn't your model just solve for the second piece, right? Because you need the actual customers to get onto the platform first anyway. So is your thinking that by offering them simply staking in exchange for trading fees, that they're just going to kind of automatically choose that by default?
I think so. Yeah, I think the little bit of yield that you would offset by saying half an Ethereum, you would lose. You're going to gain a lot more just by offsetting the trading fees. So we've modeled it out. Roughly 70% of our users participate in the free trading, versus go to Coinbase or something, which is like just 8%. So we're making revenue, roughly every 10 minutes off 70% of our user base, which is much more efficient in my mind.
It's interesting, right? I mean, there's current financial institutions that give you free trading for having certain balances and so on. So the model is not necessarily net new, but in the exchange world, it might be, especially in the crypto world. I guess a smart trader would say, well, I could get that much yield by staking myself. I'm happy to go to another exchange and pay the fees. Why don't I go do that? Because that's a better economic arrangement for me. How do you, because I assume you're targeting people that are trading a bunch, and those people see the economics and would just say, hey, this is not as good of a deal for me.
So I'm not totally sure I understand the question.
So I could just stake that 1 Ether and pay fees on another exchange and come out better. So why wouldn't I do that?
Yeah, I think there's a lot of advantages that you may have a portion on another exchange that has other products that we necessarily do not have. But if you want to do like a big buy or something like that, you've seen what the fees are. Most exchanges it's roughly 5% all in. I think it adds up pretty quickly, and people I think will understand that, and they already have.
And how does your pricing stack up to like Coinbase or other exchanges then? And are you able to get that?
Oh, if they don't participate in the free trading?
No, that do participate. Like what?
Oh, it's just on par. We use liquidity providers. There's no best bid, best offer rule in crypto, but it's always very competitive with everything else.
And where are you guys, on users live?
We have about 4,500 users. We're live in the US. We were live in Europe, and then Mika, we sort of pulled out of Europe. We also have an arm in Nigeria.
So and the ideal customer base is someone that trades frequently and is paying a lot of fees on other exchanges and says, hey, the 1 ETH staking is worth it for me to get the volume discounts for trading.
Yeah, one other thing I want to point out too is our revenue, if it's assessed in kind, that does not trigger a taxable event. So we have this ever accumulating pool of revenue that we could borrow against and actually never really have to pay tax on. And if we keep reinvesting into our own validators, even if all the customers leave, we're still going to make revenue in perpetuity.
Thank you. Great.
Thank you.
Great job, Stephen. Thank
Thanks,
you
Stephen.
so much. Take that. Thank you.